Hi everyone, it's Thursday, the 16th of February 2023. We've got a bit of a longer than usual SBS On The Money podcast today as profit reporting season rolls on. Later, the Australian unemployment rate rises to 3.7%. Does it mean a pause in official interest rates? But first, we'll start with Telstra, which posted a 26% rise in half-year profit to $934 million. Shareholders will receive a 8.5 cent per share interim dividend. That's an increase of 6.3%. How does the company feel now about the economy, though, and how has inflation impacted it and its customers? For more on that and plenty more, I spoke with its CFO, Michael Ackland.
Yeah, I think it's further evidence of our ongoing return to growth, and we're seeing real growth momentum after a very long period of transformation and disruption. We're now seeing real momentum kick into the business.
Speaking of transformation, this is the first set of results from the new CEO, Vicky Brady. How would you describe her leadership so far?
Look, I think Vicky is very deeply focused on customers, focused on growth, and focused on our reputation among the broader community and how people think about Telstra and the role we play for Australia.
We cannot talk about inflation and the rising cost of living. So how have they impacted your business in terms of A, rising costs, and B, consumer behaviours?
Yeah, it's a great question. I mean, we are seeing, like every business, inflation hit us across all parts of every cost line. We see it in the cost of professional services and corporate services, our field services, fuel, obviously energy. So it is hitting our costs. We think we're managing that well, and we have a lot of mitigants in place. From our customers' perspective, one of the things that's important, customers are still seeing connectivity as something that's really critical, and they need quality. They need quality connectivity. But we are seeing some behavioural changes with our customers. We're seeing that particularly in probably lower handset sales than we expected, customers keeping their phones a little bit longer, or even looking at lower cost consumer electronics and phones that they use their connectivity with. So some changes in customer behaviour, but connectivity is still really core for many people.
So will that mean customers will see higher prices when it comes to things like mobile plans, for example?
Yeah, so we did make some changes to our mobile phone plans in July this year, and we told customers that we would annually look at those prices in relation to CPI. We will look again when it comes to coming up to July this year. We'll do that around April, May, look at the March CPI figures. But there's a lot of things to consider there. We've got to, front of mind is cost of living for customers and the decisions that they need to make. We also need to look at our returns. As I said, we're just on the start of that recovery, that economic recovery of the business. We need to make sure we're delivering returns so that we can invest in the network to deliver those experiences customers want. And of course, we have shareholders who need a return on their investment. So we look at all of those, but front of mind is customers and the pressure that they're under, and that will be front of mind when we make decisions around what we do with prices going forward.
We've seen a large number of US technology companies slash jobs only recently. Here, the unemployment rate in Australia rose today by 0.2 points to 3.7% in January. So are job cuts at Telstra inevitable amid tougher economic conditions?
So under our T25 strategy, we don't have a target for headcount. We do have a target for cost out, and we're going to focus on being relentless about driving discipline and efficiency, but we don't have a specific headcount target in the same way that we did with our T22 strategy.
The Optus data breach really put the focus on cybersecurity, and scams in general are on the rise. How much of an issue is this for Telstra, and what are you doing about it?
Yeah, so we look at cyber as a 24/7, cybersecurity as a 24/7 battle, and it's one that you can never be complacent on. We've led out with our Cleaner Pipes program, where we're blocking millions of scam emails, scam calls, scam texts, and those numbers of blocked malicious contacts just keeps rising. I think we have some of the best capabilities in the country in our team in terms of cyber, in terms of protecting our perimeter. And we're also very focused on making sure the data that we're retaining we're only retaining absolutely the data that we need so that we have a smaller perimeter and be less at risk.
So to what extent did your business benefit from customers switching away from Optus?
Yeah, so when the Optus incident occurred, I mean, obviously our first reaction was to review all of our cybersecurity activities and understand how that attack worked, which is what you do when there's any cyber attack. But we did. There was Optus customers who came to us. We would estimate that's in the mid tens of thousands of customers that came across. That normalised pretty quick. We saw, it's called port-ins when customers change their numbers across. We saw those from Optus lift for a number of weeks, and now that's largely normalised as we move forward.
Just a couple of other questions. What do you see as the big thing in telecommunications tech?
Yeah, so we're right. The next big thing in technology, we're right in the middle of the 5G rollout, and there's more innovation to come with 5G. Obviously, there's a lot of talk about satellites. We're a very big country. Satellites will be a complementary technology for many people. But coming up next month is Mobile World Congress in Barcelona, and you'll see a lot of the new tech getting talked about in Barcelona in the coming month.
And just to wrap up, how do you see the outlook for the economy? And once again, does it mean job cuts at Telstra?
Yeah, so we don't look at it from a job loss as the target. We look at being efficient, automation, driving our digitisation programs, and that will mean that in some areas we do need less people. If I look at the economy overall, unemployment is still historically very low, and we're at the moment we feel we're in a very tight labour market. We see that in our stores, in our call centres, where making sure that we can fill vacancies and have enough people to service our customers is probably our focus right at this moment. Clearly, the business environment, there is a lot of uncertainty. We feel like we're well positioned to weather that. We feel like we deliver a product that people really value and that people really need. But we are focused on remaining disciplined on cost, as we should in an inflationary environment, and making sure that we're able to deliver best value products for our customers when they need them.
Michael Ackland there, he is the Chief Financial Officer at Telstra. Telstra shares did rise today by more than 2%, so investors liked its update. It happened on a day where the share market also rose. The S&P ASX 200 up by 0.8%, 7,410 points. For more on the day's market moves, starting first with Telstra's result, I spoke earlier with Henry Jennings from Markets Today.
Well, it was an interesting number, I guess, first under the new CEO. So it was interesting to see no longer Andy Penn there. But I have to say, Telstra seemed to be, and they always have been, dominant in the mobile space. 5G, very much so. The return of roaming has really helped them. It was a pretty solid result. They raised the dividend, which will be good news for retail investors as well. I think that's the first time I've seen a change in the 8-cent dividend since time immemorial, really. At one stage, they couldn't even afford to pay that, but they still did. So it's a pretty solid result. It shows, I guess, the power of mobile. Price rises in mobile plans are pretty sticky. People don't tend to change. If you're with Telstra, you love Telstra to an extent, especially if you're in the regions where you can't get anybody else sometimes. So a pretty solid result under the new CEO. I think there's a tick in the box for that one.
A lot of other results out today. Which ones were the ones that caught your attention and why?
Well, I guess one of the ones that caught my attention was AMP, which paid the first dividend it has paid since the Hayne Royal Commission 5 years ago. God, it's 5 years now. But it was an interesting number because they did pay that dividend, but the core business still seems to be showing problems. And although AMP had a pretty good run towards the tail end of 2022, all that came a little bit unstuck today, and the stock's down around 13%. They still do have issues with their core business, and they are losing funds under management. So that's not a good sign for the AMP, but I guess some people will take heart that they did pay a dividend, which is somewhat, at least a little bit optimistic, I guess, from the management.
A lot of other results out today. Which ones were the ones that caught your attention and why?
I guess volatility. There's an awful lot of volatility post the results. Some days we're getting very negative results, and certainly guidance is being very cautious. We saw that from CBA. So I think, there is a caution ahead, especially from retailers, those people looking at a slowing economy. And I think that is the overwhelming thing at the moment, certainly caution ahead.
Henry Jennings there from Marcus Today. Let's now go to another profit report from today. That's from Domain. Now, interest rates there impacting that company where half year profits fell 39%. The number of listings on its website off by 9.5% in the half. Where to now? I spoke earlier with its CEO, Jason Pelligrino. So, Jason, first of all, to what extent are higher interest rates impacting your business?
So our business really is tied to listing volumes across the market. And it's not so much the height of interest rates, it's the speed at which interest rates have increased in an unprecedented fashion with 9 interest rate increases over the last 9 months. So that is really creating an environment of shock and awe. And, house owners across the country are questioning when's the right time to bring their property to market. And we've seen an unprecedented impact on listing volume declines in the last half.
Okay, so going through the new year, how do you mitigate those effects?
Well, really, we've seen strong listing environments in periods in our history where we've had a lot higher mortgage rates than what we have now. So it's not about the level of interest rates. It's really about people's confidence that they can predict the future or predict the future within a band of tolerance. And really in the first half, because of the speed of those interest rates, the speed at which there's been a change in political setting, geopolitical risks, government risk, environmental risks that have happened in that first half, it really created a perfect storm where confidence was sucked out of the system. Over the next half and over calendar 23, we know that confidence will return. And history has shown us that listings don't go away. They just need an environment of confidence for people to step through all of those really complex gates and bring their property to market.
Okay, I think in your release, it said something along the lines of listings were down 9.5% for the half. What kind of activity are you seeing on your website right now, though? Can you give us an even more up-to-date read?
Yeah, listings were down 9.5% on a national basis. But it's important to note the other trend that we saw is listings in Sydney and Melbourne were down over double that. So this is Sydney and Melbourne leading the price declines. It's Sydney and Melbourne having the epicenter of that lack of confidence. And what we're starting to see in January and February is an easing of those poor conditions in Sydney and Melbourne. So they're starting to revert to the norm. We are seeing declines across the country though. And that will continue for some time until such time as that confidence returns. And it's a confidence to not predict what interest rates will get to, not wait for them to start declining, but at least a level of confidence that there are going to be no more shocks in terms of RBA signalling or rate rises above a tolerance level.
And wrapping it all up, just how challenging do you think the short term will be for your business? But at the same time, how do you feel about the future? Because the other thing we haven't spoken about too is the impact of migration.
Yes, we've performed incredibly well in the context of a challenging listing environment. So we've offset that 9.5% decrease in listing volumes with a 9% increase in our yield, the revenue through price increases, through new product innovation, and through more customers across the country taking up our premium, listing products. So we performed incredibly well. It's been pleasing to see, innovation being delivered and taken up by customers, even within the challenging environment that we see. I still am incredibly excited about Domain's long-term ability to scale and scale substantially. We're here to inspire confidence in life's property decisions, and we're having a bigger and bigger impact on the property ecosystem across Australia.
Jason Pelligrino there, the CEO of property website Domain. Now let's go to economics and Australia's unemployment rate, which rose from 3.5 to 3.7% in January, 11,500 jobs lost. So what does it mean for the RBA? Will it pause when it comes to more interest rate rises? For more on that and plenty more, I spoke earlier with Angela Jackson from Impact Economics.
Yeah, look, it's interesting. So what we've seen is the employment figures drop for the month and the number of unemployed people increase for the month. And so really across the board, we are seeing this slowdown in employment growth. And we've seen that really in the last 6 months. So there was some hope in the market that we'd see a bit more momentum, but we haven't seen that in these figures. And I think what's coming through is the impact of those interest rate increases are really starting to bite. And so we're seeing the slowdown in the labour market and increase in unemployment as a result.
So Is this a major concern, or is it the desired effect by the RBA with increasing interest rates?
It's all a matter of perspective, Ricardo. So yes, I think for the Reserve Bank, it's pretty clear that they have a view that the unemployment rate at 3.5% probably isn't consistent with getting inflation back into their target range. So they are increasing rates, and one of the things they're going to be looking at is the impact on employment. They want to see that unemployment figure rise, because I think what their view is that will take the pressure off wages growth and will make it easier for them to get inflation back within that range. So in some ways, this is what the Reserve Bank has been hoping to see. I think it also wants to see, obviously, those consumer spending numbers continue to come off and the heat come out of that, just to lower that demand in the economy. And that really is the purpose, in the end of the day, of increasing interest rates.
So is it up from here in terms of that unemployment rate?
Look, what we're expecting and what the market and what the government is forecasting is an increase in the unemployment rate. So we're expecting to see around 150,000 people added to that unemployment queue over the next 12 to 18 months. So yes, that unemployment rate will keep going up, and we expect it to, probably get above 4% again. So these record low unemployment rates are not going to be sticking around.
And finally, what does this mean for the RBA? There was a pretty obvious reaction in terms of the currency markets after the data was released. So it's almost like the markets are thinking, hold on, does this mean slower rate rises or a potential halt in terms of interest rate increases by the RBA? What do you think?
I think they're pretty firmly focused on inflation, Ricardo. So I think the statement of monetary policy last week and their statement alongside the increasing in the interest rate pretty much firmly puts them on they were pretty spooked, I think, by the latest inflation figures that showed that broad-based increase in prices, particularly in the services sector. I think they are concerned that inflation is becoming more entrenched. So I don't think it means we're going to see a halt in March, that's for sure. But I do think they will continue to look at the data, but they're pretty resolute in slaying this inflation dragon. So I don't know if the market reaction is necessarily in accordance with what the noises that are coming out of the Reserve Bank, which is they expect to see unemployment rise. They know that is part of the solution to combating inflation, but their focus really is on getting that inflation down.
Angela Jackson there from Impact Economics. This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before